You can start now.
Good evening, everyone. Good to have you here today.
Good evening, ma.
Good evening, ma.
Welcome back from today's activities. I hope you had a great day. Okay, so last week we were talking about the introduction to strategic financial management. That's the chapter 1 of our SFM test. So we saw the meaning of strategy, we saw the meaning of financial management, we saw the meaning of strategic financial management. We also saw the objectives of a company, where we saw that there are financial objectives and there are non-financial objectives. We went further to look at the decisions in strategic financial management, where we saw the investment decision, the financing, the dividend decision. We also saw risk management. We went further to look at the role of a financial manager in an organization. We also saw the roles were grouped into 3 levels, where we had the strategic, the tactical, and the operational. And then we went further to look at other responsibilities, or rather other functions of the treasury function. That's the treasury department, where we saw the liquidity management, funding management, risk management, and the likes. And then we concluded the class with the types of the treasury department, where we saw the centralized treasury department, which we stated that it is only one treasury department that is set up in that company, in that group of company. Only one treasury department is set up to oversee every other subsidiary, every other unit. Only one treasury department is set up. And then the decentralized treasury department, we saw that each subsidiary in a group will have its own treasury department. So we saw the advantages of a single treasury department or a centralized treasury department. We saw the advantages, we saw the disadvantages. So today, we are moving on with advantages of centralized treasury management. So that's where we will start from today. And don't forget that when we talk about this centralized and decentralized, look at a country that has, okay, let's say ABC Nigeria Limited has, let's say it's located in maybe Singapore, and it has its subsidiary Nigeria, Ghana, Kenya. Now, the decision to make is, what kind of treasury department are we going to use? Using a centralized treasury department may not function very well, as these organizations are located in different countries, right? So that is why I ensure that I mentioned that the decentralized, most times, it's usually obtainable in multinationals. It's usually obtainable in multinationals. So under decentralized, the head office may control the borrowing, the investment decision, cash management, and the likes. While under the decentralized, it is each subsidiary that has great control or great authority to manage all their treasury activities. So having said that, let's look at the advantages of decentralized treasury management. And the first one here says autonomy. Now here, if every individual subsidiary have the authority to make their financial decisions, yes, so the subsidiary does not have to run every time to the parent company for every financial decision. Let's say that a Nigerian subsidiary needs a short-term 50 million or 100 million or thereabouts facility. Now, if it has a treasury autonomy, right, it may be able to like negotiate the facility by itself rather than waiting for approval from the head office. So the point I'm making here is that each company is given the power to take their financial management decisions. That is the first point, autonomy. Now, moving to the second one, there is quick response to local needs. The company will be able to respond quickly to local needs. Now, the local treasury team understand its own market better, like what we said the last time. They understand their markets better. They understand their environment better. Now, Nigeria understands our interest rates. We understand our local business opportunity. So it will help the subsidiary in that particular country to be able to respond quickly to what they have at hand, to their local need, because they understand it better. Now, the third one talks about making timely decisions. Of course, it's also closely related to responding quickly, where the subsidiary doesn't have to wait for instructions from the head office, right? Now, for example, it's favorable for a short-term investment opportunity that comes to a subsidiary or to an organization. Now, they have looked at it that it is a favorable one. They don't need to start waiting for the head office, or rather the Treasury Department in a centralized center. Now, they are not supposed to be waiting, right? Because this is a decentralized, so they can easily, act immediately because they have seen a short-term investment opportunity that is profitable. So they just act immediately. That's what it means by timely decision making. Unlike the other one, centralized, where they have to wait, right? They have to wait for the centered Treasury Department to scrutinize, make inquiry, ask questions, and maybe before you know it, such opportunity will pass by. Then the fourth one says that the local department may find it easier to diversify sources of finance and match local assets. Yes, a local treasury may have access to financing opportunities that the parent company may not easily have, like local bank loans, local credit facilities. It is only the local treasury that will have access to such financing options, right? Then the last one talks about that a decentralized operation may find it easier to invest in its own balances quickly on a short-term basis than a centralized function would be or would. Now, what does this mean? Let's say that Nigerian subsidiary has 100 million naira. It will not have to use it for the next 30 days, right? Now, what it means is that in a decentralized treasury function, they will be able to invest their surplus immediately. Unlike the centralized, where they will have to send all the money to the head office for them to now make decision on what to use the money for. Now, in a decentralized, one of the advantages is that they have the ability to make quick investment of their surplus cash. I don't know if we are following. They have the ability to do what? To make their decisions based on what they have at hand. They don't need to start waiting, especially when they have seen that there is this investment that we can always make in a short term and we make our profits and move on. So they use their surplus cash, they invest it and they move on. So they don't have to wait and hear from the head office. These are the advantages of decentralized treasury management. Now let's see the disadvantages of the decentralized treasury management. Now the first one here is higher cost. Yes, of course, having known that each subsidiary will have their own treasury team, will have their own systems, there is an increase in cost because they will need a staff, they will need technology, and all these things will cost the company more money, unlike where it is just one person that is doing it. Now, each subsidiary, each business unit will have their own, and they'll have to, of course, they will have staff, they'll have a treasury officer in that particular department, and they're going to pay salaries, right? They will get new systems for them and different technology for them to work with. So there is a cost involved. This is one of the disadvantages. Higher cost implication. Now, the second one talks about duplication of efforts and resources. Now, different units may perform the same treasury activities separately, leading to duplication of staff, systems, and processes. Now, let's look at an example like Nigerian Treasury negotiating with a bank, right? I'm still talking about the example of ABC Limited that has a branch, a subsidiary in Nigeria, a subsidiary in Ghana or Kenya, thereabouts. Now, the Nigerian Treasury will negotiate with bank. Ghana Treasury will also negotiate with bank separately. Kenya Treasury will also do the same. So the group could potentially have negotiated better collectively, but now individually, they are doing the same thing for themselves. And at times, their negotiation may not be favorable. Some may have a higher interest rate, some may have a lower interest rate, whereby if it is a group company, the central treasury management function is the one carrying out that particular task. He may know some, what banks that he could, go have relationship with, connect with them and transact such business, unlike having it done in the local branches. So that's duplication of efforts and resources. Okay, so we move to the next one that talks about inconsistent policies and procedures. Different units may adopt different approaches to cash management, investment, borrowing, and risk management, making it difficult to maintain consistency across the organization. Now, what this is talking about is that one subsidiary may have a conservative investment policy, while another takes aggressive investment decision. Right now, one may want to hedge foreign exchange exposure, while the other one does not care about all of those things. You get, so this makes the group very, wide, or like control. The group control will be difficult because there are inconsistency in their policies and procedures. This one is looking at what are the risks involved. If the dollar or the exchange rate, it goes higher than what we expect, what do we stand to gain? How do we do it? This other country is looking at, hedging their foreign exchange exposure. This one does not consider those things. So these inconsistent policies, we make it difficult to control the group. Then the next one talks about increased risk. Now, decentralized control can make it harder to monitor financial activities, increasing exposure to fraud, poor investment decision, liquidity problems, and foreign exchange risk. Now, this talks about, because that the decision making is spread across different units, head offices may have less visibility, right? They may have less visibility, and there's potential risk of a fraud, poor investment decisions. Like, they just want, let's just invest our surplus cash. Now, they may not have, considered critically the impact of that investment, or rather, they may not have put in place a risk management measures in case there may be, because of course there could be likely occurrence of something you did not expect, right, in a bad way. So if such things are not put in place, there could be excessive borrowing, there could be, fraud in the organization because they are allowed to do whatever thing they want to do. They have different functions that can carry out their treasury functions by themselves. Different subsidiary can do it on their own. So there could be also liquidity problem. Now let's assume that this Ghana subsidiary can function in that like. Now they decide to invest their money. It happened that the head office critically needs some fund to carry out a project. Meanwhile, their subsidiary have used their own to do what? To invest somewhere. So there is a liquidity problem at the head office. Why? Because they are operating a decentralized treasury management system. I hope we are following. Okay, so let's proceed. Yes. So we have. Thank you, ma'am. Let's proceed. We have treasury, cost center, or profit center. Now, this is just trying to, give us an explanation of a treasury department being either a cost center or a profit center. So organizations decide whether they want their treasury function to operate as a cost center or as a profit center. So now the question will now be, should the Treasury Department be expected to make money for the company, or should it simply provide treasury services at a cost? If you were asked this question, what would be your response? Should the Treasury Department in your organization operate to make more money for the company, or should it simply provide their treasury services at a cost? So moving on, we are looking at the cost center now. Let's explain what cost center means when it comes to Treasury Department. Now, cost center treasury is primarily a support function and focuses on managing costs. Its objective is not necessarily to generate profit, but to manage the company's cash, financing, and financial risk. So its objective is not to generate profit though. Their own is just manage the company cash. How do we mitigate financial risk? How do we finance so as not to run into excess loss? So this is their main target. Their own is just to manage, right? Now, for example, it could want to look at some costs attached to what they are doing, some costs attached to, like, they want to invest. What is the cost of this investment? They are always after the cost. What are we losing? What are we spending in securing this particular investment? Why the profit center is just after how do we generate profits? How do we generate more income? Right? The Treasury is expected to generate income for the organization. It can be through investment, it can be through foreign exchange transaction. So this part of them being profit center will now make them to start taking excessive risk, because of what? They are meant to generate profit. They are meant to generate more money to the organization. So they take excessive risk without being concerned of what could be the outcome, what will happen if peradventure what we projected doesn't come in line with what we are looking for. They don't care. What they know is that what they want to make profits for the organization because they are profit centered. Now, them being profit centered will also mean that if they are rendering service to their subsidiaries, right? If they are rendering services to their subsidiaries, they will charge them. They will charge them. It's not going to be a free service. They are going to charge them because of what they are operating a profit center, and they are going to charge them as the way it is done in the market, like market value. It's not going to be like related party transaction, transfer pricing, and all of that. No, they are going to charge them exactly what it is in the open market, in the external market, right? Now, let's see the main advantages of operating a treasury as a profit center rather than as a cost center. Now, the first one is potential for additional profits, right? Now, the Treasury can generate additional income for the organization. That is, if surplus funds are invested effectively, the Treasury may earn what? Investment income. This is one of the advantages of operating a Treasury department as a profit center. One is that there is potential for additional profits, in the terms that they have surplus fund and they decide to, invest it, and the investment happens to, yield good returns, then you see that there is an investment income. That's why some financial statements you see after they have finished their profit or loss and all of that, they will now put all other comprehensive income. Some of those income are not directly traceable to the daily activities of the organization, right? Some of them are just other investments they decide to carry out with their surplus funds. Now, they look at the department is motivated to operate efficiently. Now, if the Treasury performance is measured based on profitability, the team may become more conscious of financing costs. They may become more conscious of investment returns. It's to encourage efficiency. They want to do more. They want to be looking out for investments that they can put in place so that they will have more returns. Then there's transfer cost to the business units. This was what I explained earlier, that when they operate as a profit center, they will always want to charge the business units for rendering treasury services to them. Now, each treasury provides services to different units. Those services can be charged at market-related prices, right? Now, let's say that a treasury function financing the activities of maybe the manufacturing division or the retailing division, whatever division they have. Now, instead of saying that the treasury cost is, let's say, is 5 million, the business unit can charge it based on the actual market value or cost of that services it provided. Maybe the cost outside is 7 million or 10 million. Now, because it's a related party transaction, in terms of transfer pricing, they may say, okay, pay us 5 million. But because it is a profit center, it is that 7 million that is the market value. That is what that subsidiary is going to pay. So transfer costs in the business will be realistic. This is an advantage to them. It's realistic as they should be at the market value for services rendered. Okay, so let's proceed to the main disadvantages of operating a treasury department as a profit center. Now, one of it is that there is potential for huge loss due to speculative deals. Now, this is probably one of the most important disadvantage, because if the treasury is chasing profits, it may be tempted to undertake speculative transactions, right? Now, for example, let's say I would just, as a finance manager, I will just tell my organization, I think the dollar will fall, right? So let us take a huge foreign exchange position. Now, if my prediction is wrong, the company could suffer a huge what? A huge loss. So the Treasury Department is meant to manage risk and not to become a risk gambler. I don't know if you get the point. So there's potential for huge loss due to speculative deals. So we are meant to manage and not to start saying, is it this or is it not that? So we should know that it's possible that the foreign, because we don't have control over the exchange rates, we don't have control over it. It could go up to favor us, could go down, and all of that. So if the organization is operating a treasury department as a profit center, one of the disadvantages is that there could be a huge loss because they always want to, let's invest, let's just invest, let's invest because we need more, we want to make returns. At the long run, there could be a huge loss if the deals do not favor us. Now, the second one is additional administrative cost in running a profit center. Now, a profit center requires additional systems. Of course, there should be somebody, because there will be check and balances. One person will not have to record transaction and also monitor, right? One person will not have to also, be the one to invest. So there could be 3 to 4 persons monitoring the activities. So one person is recording, one person is allocating the income and the cost, another person is reporting, another person, the head, is monitoring. So you see that there's additional administrative costs. More staff are needed in this instance. Now, the last one there says the additional cost of management time spent in terms of negotiating transfer prices. Now, in this instance, different business units may argue about what treasury services should cost, right? Now, for example, that a treasury said, our services we rendered to division A is 10 million naira, is worth 10 million naira. And division A says, no way, is 6 million naira that we are going to pay. Now, the management will be on top of the matter, trying to resolve the disagreement. This one is having in his book 10 million. This one is having 6 million. What do we do? You see that it takes the management more time to be able to bring these two departments, these two divisions together to come to a conclusion and say, okay, you want 10, you want 6. Okay, let's share it, let's do 8. So time is involved. It's not something they just wake up one morning and do. So the additional cost of management time spent in terms of negotiating the transfer prices. That's what that place talks about. So as we proceed, I have one short question for us. So now the first question is, what is the difference between a profit center and a cost center treasury management? You can unmute and speak, please. Difference between profit center and cost center. If you're following the class, please unmute and speak.
All right, good evening, ma.
Good evening, sir.
Okay, sorry, just as the name denotes, cost center, they are solely for their main objective is to manage costs, to incur costs and then manage costs, and then anything that has to do with but their main objective is just to manage costs, to ensure that their risks are being managed efficiently. Why profit center, their main objective is just to generate revenue and profit for the organization. So they do whatever they think would bring in money, would generate income for the organization. Thank you.
Thank you so much, sir. That was a good one. Okay, so you can also tell us why you think it is okay. No, you choose now. Profit center and cost center, which one do you think is the best for an organization to operate with, and why? So your answer, you just give us a reason why you chose whichever one you choose. Yeah.
My own, I don't know whether it's a question or a contribution.
Okay.
Can't a treasury be both a cost and a revenue center or profit center? Like
yes,
one
an
treasury.
organization can choose to do both. An organization can choose to be both cost and the profit center, and then it will still require a whole lot.
I am in treasury department, and I think we are both revenue and cost center, because a lot of times when we are doing transactions, we look at, like for instance, we have some overdraft accounts, right? So there are some transactions we want to do with these overdraft accounts, and that will now calculate the profit we are going to have on these transactions and see whether it is okay to open these ODs because of this transaction. You calculate the profit you're going to make on this trade, and then calculate the cost of the OD and see. So we balance both. Like we as much as we want to make revenue, want to make profit, we also are looking at the cost aspect of these transactions, if it benefits us or not. Because you can make trades, make transactions, and at the end of the day, you make nothing or even make a loss because you left your ODs open because of this transaction that did not bring enough profit to close it. I don't know if you understand what I'm saying.
Yes, I get your point.
Okay.
Yes,
so
organization can operate on both. They can do both cost and profits. Yes. Why some just choose on cost, some choose profit, but most organizations, like in this part of our small organizations, not multinationals are always discreet about what they want. So what we do most times, we operate on both, right? We do both. We do cost, we do profit center, whereby before we make any investment, we will try to look at our cost implications, right? We don't want to just invest, and at the end of the day, we have nothing in our hands. So we look at both possibilities. If we invest, what do we have? We try to balance the two equations, so the company will keep on moving forward. Thank you very much, Ma, for that wonderful contribution. Okay, so we proceed. We move to stakeholders. Stakeholders is not a new word. We've all known and heard about this, even from maybe for those that started in foundation or skills, or even in our universities and all of that. Stakeholders is something we have known and we've heard. right? So a stakeholder is a person or a group that has an interest in a company or can be affected by the company's activities, right? Now, looking at in organizations, now there are different stakeholders. There are different stakeholders. It could be direct stakeholder or indirect stakeholder. Like I think in those days, CSME was, differentiating direct, indirect, and all of that, internal and external. So those stakeholders, the most important thing is that they have an interest in the company. It could be direct interest, it could be indirect interest, but they have an interest in the company. And whatever activity or whatever decision the organization takes affects them. That is why they are called stakeholders. Now, theoretically, the main objective of a private company is to maximize the wealth of the shareholders. Other individuals and groups also have interest in the company, which influence its corporate objective. So shareholders are stakeholders, but not all stakeholders are shareholders. Of course, we know that shareholders are part of the stakeholder groups. They are the owners of the company, right? But since they are stakeholders, it is not all stakeholders. Like other stakeholders, we have the lenders, we have the employees, we have the government and customers and all of that. They are stakeholders, but they are not shareholders. So shareholders are stakeholders, but not all stakeholders are shareholders. Now, these stakeholders may be grouped into the following. We have internal stakeholders, the people within the organization, right, who have interest in the company. They are within, they are inside the organization. So examples are the directors, the managers, the employees, the shareholders. They are in the organization. Now we have external. These are people outside the organization who do not have, who nevertheless have an interest in what the company does. They are not in the organization, but they are interested in what the company does. Example is the government. Of course, we know that government is interested in what companies and organizations do. That's why every time they tend to bring new laws, new ways of doing things, new tax law, tax rate, and all of that, because they are interested, new ways to comply and regulations and all of that. They are interested. Also, the society where the organization finds itself, they are interested in who are this company in our society, in our community, in our village. What benefit do they have to offer to us? They are interested, they are watching you, they are watching the organization. The lenders, of course, somebody that lended money to the company, he's even very much interested because he needs the money back. He doesn't want to hear that this company has liquidated, this company has gone bankrupt. He doesn't want to hear that. So he's so much interested. The same with customers and suppliers. So let's look at what does each stakeholder want. What does each stakeholder want? Now look at the employees. Employees depend on the company for their income and livelihood. Now the company is the source of the employees' income. The employees' interests in the company include competitive salary, job security, and career advancement, right? Some of us that are employees in one organization or the other, you can attest to this, that one of the things we want is a competitive salary. We want job security. We don't want a situation we come to work tomorrow morning and there's a letter on our table saying that we no longer need your services, blah, blah, blah. No. We want job security, we want career advancement. And sometimes when we go for interviews, you ask them, what career growth opportunity, what career advancement do you have in your organization? These are the things that employees are looking out for. Place where you will be motivated to grow in your career. So the personal wealth of these employees is dependent on the company. There are some companies you work with, you may not even have time for your own personal activities. Maybe you want to do some side hustle. You may not have that time to do that. And in that case, your personal wealth is dependent wholly on the company. Now let's look at the directors and senior managers. An organization An organization is led by its own board of directors and senior executive management who are responsible for running the company. These are individuals whose careers, income, and personal wealth might depend on the company they work for, right? Now, looking at the directors, the managers, they have their own interests, and sometimes their interests may even be different from what the shareholders are looking at. It may be different from the shareholders' interest. That's why they have conflict of interest. Now, the directors will be looking at salaries, good pay, bonuses, personal wealth, good incentive. They want to have their own car and personal driver. They even want to have domestic staff, right? These are what senior managers and directors, these are their interests in the organization. They want to have a good reputation. I am the manager of so and so oil and gas. Hearing that big name, it will, there's a place you enter, they announce, they read your portfolio and call you manager of so, MD, director of so, and that reputation, you will feel fulfilled. Now, career progression. So many of our big bosses, directors, and senior managers are in organization where, as we are talking about ICAM conference or whatever, the organization will sponsor it fully. When I say fully, starting from the fee, their transportation, their hotel, their feeding, even their clothing, they will sponsor that. Why? Because of their position. And so these are the interests that the directors and senior managers have in organizations. And these their interests, of course, is going to be different from what, because all these things could look extra, it could have an extra cost effect on shareholders. They will feel like it's too much, they will feel that if we do all of this, our profits will reduce, thereby we will not even have plenty dividend to share. So that's where their conflict of interest comes into place. So look at the shareholders. These are the owners of the company. Of course, their interest in the company is to maximize their wealth in form of increased dividend and growth in share price, right? Now, then the lenders, they are the people that provide debt capital to the company, right? Their interest in the company is timely payment of interest and repayment of principal, so that they can also use it to do more business. They can give to somebody else. They love payments being made timely. Don't wait for them to always call. So this is their interest in the organization. There might also exist debt covenant. And somebody may ask, what is debt covenant? I know you should be used to that word by now. A debt covenant is a condition or restriction agreed between the lender and the borrower to protect the lender, right? A condition or a restriction, like an agreement binding the lender and the borrower to protect the lender. So there may also be debt covenants signed in order to reduce credit risk. Remember, the person facing this risk is the lender, because he's the one that gave out the money. So it is, if the money is not being paid, the risk has taken effect, whereby he has lost on that. So there's risk involved in lending money to people, because there's possibility that they might not pay. So that's why there's a debt covenant, to cover the lender, to protect the lender, right? Now let's proceed. Customers. These are those who are interested in the goods the company sells or services rendered. They should be certified in terms of quality, good customer service, reasonable price, and timely delivery of goods. So recently, I've been seeing there's this medication that have been flying up and down, and people are saying that NAFDAC have banned such medication from consumption, that is harmful to the health. Now, the customers are interested in goods, of good quality. Goods, especially what people consume, what people eat, what people rub on their skin. They need quality goods and not something that will have an after effect. So this is the interest of the customers to the company. They need good customer service. When they call the marketing team, please, do you have so and so? And now somebody will say, okay, let me get back to you, ma. 1 day, 2 days, the person has not gotten back to that customer. So they need good customer service. They need reasonable price. In as much as you're giving them quality goods, it should be at a reasonable price. Not because you want to give a cheap price now, you go and reduce your quality. Those customers will identify that. And when they identify that, those customers will leave that company. They will stop patronizing. I'm not just even keeping quiet. They may even go as far as talking down on the organization. These people, they sell fake products. Don't go there. So these are the interests that customers have in an organization. So let's look at the suppliers. So suppliers provide the inputs, or rather the resources the company needs to operate, right? So for them having provided those resources, they want prompt payments. They want to be paid on time. They want fair terms, and not that they supplied goods to you and then you agree that you're going to pay in 30 days, or because you know they are suppliers. When your customers are owing you, you want your customers to pay you in 30 days. Then when the suppliers are, you are owing the suppliers, you want to take it to 90 days. So I mean, we will exceed to 120 days. How then do you expect the business to continue? So these are the suppliers' interests in the organization. They want their obligations to be settled as at when due with fair terms. So let's look at government. So this group is interested in what the company does in terms of payment of tax, strict compliance to certain rules and regulations, proper business practices. Now, of course, we know that government could require some level of regulatory compliance from an organization. It could be in terms of what the company is into, maybe oil and gas, there are regulatory requirements for them. It could be some registration or some documentation or some licenses that they need in order to practice. These are the interests of the government. They want to look at the organization. Are you abiding by this? Are you paying your tax as at when due? Are you doing that? So this is what the interest of the government in an organization. Remember, the government is also a stakeholder. So we look at the society. The society needs should be considered by the company. Issues such as human rights, preservation of the environment, business ethics, community development should be considered by the company in order to strengthen its reputation. So society is interested in the impact the company has on the community where it is located. What impact do they have? Let's say, for instance, an oil company operating in an area should also do what? Consider the environmental impact of its activity. There could be times of oil spillage. Now, do you have provisions for such time where there will be oil spillage? Have you made arrangements, or there will be oil spillage, the water of the community will go bad in 1 week, 1 month, you still have nothing to do about it? So these are the things that the society are looking out for. They are interested. Now that these people are coming into our community, what development are they bringing? Some organizations go to community, they walk the road for them, they build schools for the community as a way of what? Of affecting the community. Sometimes they even employ the citizens of that community, depending on which area they can function. If they are graduate, they could put them in their offices, maybe depending on their qualification. If they are not, they could make them their janitors, their securities. All these are just a way of what? Impacting on the society where they operate. So that is why I say that society is also a stakeholder, because when the society is not being considered, you see them, that company, they will frustrate that company. They can start rioting. They can start up one day and they start rioting. And when such thing is happening, that community, that organization may not be able to function. So that is why society is also a stakeholder. So let us proceed. Is there any question? Should I proceed? Should I proceed? Okay. All right. Thank you, sir. Okay, so we look at conflicts between different stakeholders. Now, different stakeholders have different interests in a company, and these might be incompatible and in conflict with each other. When stakeholders have conflicting interests, two things can be done. Is either there will be a compromise. When I say compromise, I mean, the interest of one group will be satisfied partially, right? Each of the stakeholder group, their interest will be satisfied partially. Let's say that the staff, the employees, they want a 20% salary increase, right? And then the shareholders, they want a higher dividend, right? Let's say they want 10%. They were usually giving 5 and they want 10%. Now, there could be a compromise. Instead of giving the employees 20%, they can be giving 10% increase. And then instead of paying the shareholders 10% or 7%, whatever, they can move them from 5 to 6%. So it's just, trying to balance in between, trying to see that both stakeholders involved, right, are partially satisfied. That is one. And then the other one is that the most powerful stakeholder group will be satisfied while the other will be ignored. Now, it could be, let's say, the lenders. The powerful could depend on the particular circumstance at hand, right? Now, let's say that the lender that gave money to the organization, there is an interest to pay and the time is due, and the lender needs their money ASAP for other business dealings. Now, and also, then the staff, they are looking for a pay raise for like maybe 20%. Now, the organization could say, staff, you people should wait. Maybe in 3, 4, 5 months' time, we'll do a review. But for now, let us sort out the lenders. So you see that this other stakeholder group is ignored. The employees are ignored. And the one that has the most power as at that time, which is the lenders, is what is being attended to. So these are the two ways they can handle such conflicts. It could be through compromise, satisfying them partially, satisfying all stakeholders involved partially, and then it could be ignoring one and satisfying the most powerful stakeholders. Okay, so let's look at some examples of conflicting interests of stakeholder groups. Some examples of conflicting interests between stakeholder groups. So we have here the government versus the shareholders. Of course, we know that government wants more tax. Shareholders want higher profits and higher dividend, right? So suppose a company makes 1 billion naira profit. The government will say, pay your tax. They'll apply their percentage, 30%, pay your tax. And the shareholders will say, we want more dividend. So the shareholders may prefer to, try to minimize its tax liability legally so that more profit remains available to shareholders, right? So the government might want to receive more tax or on a company's profits, whereas the company will want to minimize its tax liability through effective tax avoidance scheme. I hope we know that tax avoidance is a legally approved, like it's a legal arranging affairs to do what? To reduce tax. It is not tax evasion. Tax evasion is illegally failing to pay your tax. So the organization can, make use of tax avoidance schemes in order to do what? To pay or reduce their tax. So we will move to shareholders versus employees, where we talk about profits and wages. Of course, the shareholders, we want the organization to have more profits, right? when they it's more returns come to their returns. Why employees?
Your voice is cracking, man. Why not?
Sorry about that. Okay, so can you hear me now?
Yes, my it's better.
Oh, sorry about that. Oh, can you still see my screen?
No.
Okay. Let me share again. Can you see it now?
Yes, we can see it.
Okay, sorry about that. Okay, so we're talking about the shareholders versus the employees. So if the shareholders' interest is more salary, the employees' interest is more salaries, you know, that is going to increase the administrative costs, thereby reducing the profit. And when the profit is reduced, of course, shareholders' wealth will also reduce, right? So a company cannot maximize returns to each shareholder if it also seeks to maintain a contented workforce. Employees, we always want more. We always want more, because as the country, as cost of things go high, we start desiring for them to do an increase. So this is a conflict. There is conflict of interest between the shareholders and the employees. Then we also have environmental groups versus the shareholders. Now, the environmental group may say the company must spend money on proper waste disposal and environmental protection, right? And the shareholder may say, we are spending so much money, we want higher profits. All these things you people are doing is going to affect our profits, right? And you know that a factory that deals with some waste products can not just trash it anyhow. It must be done accordingly. They can dispose their waste with a good environmental safe disposal agency, and it is at a cost. So these things are costs that will reduce the profits, or rather the returns that the shareholder are looking at for. And you see there is a conflict. A company cannot maximize short-term profits if it spends money on environmental protection measures and safe waste disposal measures. These are very important things in organization. Most organizations, like those in the safety, those in engineering, construction, these are very important, the way they deal with their disposals, their waste disposal. But some shareholders may be looking at it that it's going to reduce their profits, but there is a conflicting interest, because there are checks. There are people that come around to check, how do you dispose your liquid, how do you dispose your metal, and all of that. Then we have managers versus shareholders. I think I've seen this in ICANN Pathfinder. The conflict of interest between managers and shareholders can arise in the following ways. So we are going to be explaining this one after the other, right? Now, the shareholders, remember, they own the company, but the managers run the company on their behalf. The managers run the company on their behalf. So the first one here talks about information asymmetry. Now, this place talks about, the managers, they are the ones in the business, right? So they have better or more information more than the shareholders, because they see the daily activities. They first know that they are making profit before it gets to the shareholders, right? So the managers have detailed information about the business. Meanwhile, the shareholders may not have the same level of information, right? So before the management, the shareholders will know that the company sales is going down, the management is already aware. And so this creates an opportunity for managers to start acting in their own interest. And that is why that's why corporate governance came in place, to do what? To help guide and model the ways directors should act in organization. So the information asymmetry talks about the directors, that is the information gap, right? The information gap between the directors or the managers and the shareholders, because they are in the business, they see when profit is going up, they see when it's dropping. So they tend to now, start creating opportunities in their own interest. They start, they may start looking for ways to make amends so that it will not look like they are not doing well. Maybe there are some investment opportunity they should have done, but because they are seeing that their profit is dropping, they will not do it, so that they will paint the reports to look good. So that is what information asymmetry talks about. Then we look at dividend policy. Now, the shareholders may want more dividends to be paid to them, while the managers will want to retain more. Yes, they want to retain more. Maybe they'll say, let's pay them 30%, let's reserve 70% for the future, so that we can use it to be running the business. Now, the truth is that when that 70% is reserved, it pays the organization it helps the organization to look big, to grow. Now, when you look at their financial statements, when you look at their statement of financial position, you look at their retained earnings, wow, that's very large, and it will make their net asset to look so big, right? Now, in that instance, when such thing is seen in the statement of financial position, or rather in the financial statement of the organization, now people are now interested. People want to invest. This company, they look good. This is exactly what the managers are looking out for, right? And by so doing, when people want to invest, they will now be telling the shareholders, now look at, we are making progress, we need a raise, we need an incentive, and all of that. Meanwhile, this was exactly what they were looking at from the onset, that made them to say, let's pay 30% dividend and keep 70% in our retained earning. So that's what the dividend policy talks about. Then we proceed to merger and acquisition. Now, a manager may want the company to acquire another company because it makes the manager's empire bigger, right? It makes him, his status to look big. I'm a manager of so, I'm a manager of so place. So it makes his status to look big. So he may want to, acquire more company. Now, let's say, for instance, that supposing that they are supposed to acquire a company for 10 million, and then the managers will not do some due diligence to ensure that this acquisition they are about to do is profitable, is worth doing, is worth doing. It's not just, let's just acquire business. They may not want to look at that. Their own is just let them answer names of people working in an organization that acquired a very bigger organization. So they want to maintain their status quo. Meanwhile, the shareholders, this is not their own aim. This is not their own interest. So there is a conflict between both of them. Then excessive compensation. The manager may award himself excessively, right? The manager may say, let's pay so percent, let's pay 50%, let's pay 40%. Why? Because he's the one involved. He's the one there. He's the one doing the decision. And the shareholders is not what they also want. There's a conflict. Shareholders want their wealth to be maximized. And then the managers are looking for excessive compensation. They are looking for the highest car to ride. They are looking for the highest place to go for vacation. So you see, at the end of the day, the shareholders' objective are not met. Then we have related party transaction. Now, supposing the managing director awards 100 million naira contracts to a company owned by his own brother, right? His brother owns that company and he awards that contract of 100 million naira to his brother. Meanwhile, another company could do the same job for 60 million. You see, now because this is his brother's company, he decides to award the 100 million naira contract to his brother. That is related party what? Transaction. And the shareholders may not even be aware that it was a related party transaction. They may think it's done at arm's length. Now, at the end of the day, the shareholders are losing what? 40 million. The manager's relative is benefiting. Even the manager will benefit because there will be something for the manager. So that is what that's part of it. Related party transaction talks about. Are we following?
Yes, we are.
Okay. So the last part talks about, however, the most significant conflict of interest between stakeholders in a large company, especially a public company whose shares are traded on stock market, is generally considered to be the conflict of interest between the board of directors, especially the executive directors and the senior executive managers. Now, this perceived conflict of interest is fundamental to agency theory and the concept of good corporate governance that have developed from agency theory. So what this place is explaining is that there are conflicts that exist between stakeholders of organizations, between their board of directors, their executive directors and their manager. There's always this, this conflict. What should go to who? Whose interest should we look at for, right? Everybody is looking out for their own interest, especially those in the business, the managers who operate on the day-to-day activities. So that is why it is this conflict of interest that brought about the agency theory, that also brought about concept of good corporate governance, how organizations, how the board of directors, the duties of the directors, the remuneration, how everything should be done in an organization. So we'll see to corporate governance in our next class. Okay, so let's look at stakeholder capitalism. It is, however, argued that if earnings are not maximized, dividend and increase in share price are not certain. If earnings are not maximized, dividend and increase in share price are not certain. As a result of this, companies should not pursue shareholders' interests alone. Other stakeholders' interests should also be considered, as many of them take decisions that impact the profit of a company. When they take decisions that impact profit negatively, the shareholders' wealth might not be maximized. Now, this place talks about that we should not focus only on the shareholders, right? We should also consider the interests of other stakeholders. That is what stakeholder capitalism is all about. Don't say you're just there to maximize profits. No, don't pursue only the shareholders' interests alone. Pursue the interests of other stakeholders too, because their decision also will impact on the profit of the company. Imagine you do not look for a way to, make the employees to be happy working with you, and then they leave. Maybe your most competent staff or the person at the forefront, at the battlefield, decides to leave the organization without notice. Now, what this does is that the organization is not going to shut down, no. But what happens is that it's going to take them, time. Let's say they were at the peak of, doing a particular investment or doing a particular job, and then that person leaves, you see that they start struggling, they start looking for a way, they become disorganized at that point, right? So every stakeholder group is important, and their interests should also be considered. That is what stakeholder capitalism talks about. So directors and managers who take business decisions might decide to take decisions that will reduce profits, approve contract for suppliers who are related to them, right, at a price considered too high. This is what we have talked about before. What's the interest of directors and managers? They may want to, approve a contract for their brother, their relative, their friend, right, at a high price because it is their relative. Meanwhile, when it's being done with someone else, it will be at a lower price. Then the government may decide to amend existing laws that could even reduce the profit of the organization. Even customers may decide not to patronize the company again, and all of that. So stakeholder capitalism, in summary, talks about that the organization should not just focus on the shareholders alone, maximizing profit for shareholders. No, they should also move forward to looking at other stakeholders. They should also consider them and make sure that everyone is carried along. So we move to agency theory. We are progressing. Okay. So we know that agency theory is a theory that talks about the relationship between two parties, right? Talks about relationship between the principal and the agent. And the principal, of course, we know are the owners, the shareholders, and the agents here we talk about is the directors and managers, those that are being committed to carry on the activity, the day-to-day activities on behalf of the shareholders. So they are the agents, the directors, and the managers. Now, agency problem arises when agents do not act in the best interest of the principal, but rather in their own selfish interests. The conflict of interest between directors and shareholders led to agency theory. Now, for a quoted company, ownership and management of the company is separated. The owners are the shareholders, while management is carried out by directors. The shareholders hire the directors to manage the company on their behalf. In this case, shareholders are the principal, while the directors are the agents. So agency conflicts are differences in the interests of the company owners and the managers. They arise in several ways. So I just use this as a what do you call it? Like a short word acronym, right? M3. I use it as acronym to help remember it. Sometimes in some of these courses, they may have objective functions and all of that. You can just devise a way to use acronyms to remember. Once you remember that your acronym, you'll be able to say. So I use this one, M3. So once you see 3 and then you put M in front of it, you'll be able to remember that this is the agency conflicts. These are different interests that has to do with the company owners and their managers. So the first one talks about moral hazard. So moral hazard occurs when managers use company resources for their personal benefits, especially when they do not bear the full consequences of their action. Now, what does this mean? Like the managers, they want to have a car, they want to use expensive hotel. Now they are using the company resources for their own personal benefits without considering the consequences, without considering the effect it has on the organization. There are organizations that their managers will like, there's money now, there's money, bring the money, there's money, let's spend the money, right? So their own is just, let me just satisfy myself let me take the best hotel, even though there may be some affordable ones, but they want to go for the very expensive one. Why? Because the money is not coming from their pocket. So they are just there for their own personal benefit. They are just after their personal benefit, but they do not what? They do not care about what? The consequences. So that place says, this deals with manager's interest in receiving all the prerequisites of his office, like domestic staff, company cars, use of company airplane, company-sponsored holiday trips with family abroad. Such moral hazard, which increase if the manager has no stake in the company. You see, now the manager, you know, there are organizations where the manager has a share. The managers have share, right, in the organization. So in that case, the manager has a stake in the company. He has something there that he knows that if this organization does like this, now this my investment is gone, right? But whereby the manager does not have a stake in the company, those things they desire, right, they feel is their incentive, their entitlement, may tend to drain the company's earning, which means reduction in the value of the company. The shareholders' wealth and the value of the company will reduce if these incentives and demands of executive management are not kept in check. If they are not kept in check, you want this, you want that, this is what I'm entitled to with my level in this organization. Now, if those things are not kept in check, it may drain the company. The value of the company may drop because of what? They will be spending so much. Let's move to the second one, time horizon. So this talks about short-term versus long-term investment or interest. Now, directors, you know, their performances are judged based on short-term. When you are telling a director, if there is a 10% increase in profit, we are going to give you 5%, or we are going to give you 3%. Now, this will make the director to start, you know, looking for short-term opportunities, so short-term investment. The managers will be making decisions that will improve that year's performance because of what? There is something they are after. There is an incentive. There is something they will acquire from meeting that target. So, and at the long run, it may even damage the company. But what they are after is right now, short term, this year. By December, I will have so amount of money. So let's pursue for now, not long run. So you see that a manager may want to meet this year's profit. He may not even want to invest in staff training, because staff training will increase cost. Research and development will increase cost. So his own is just some of those things that will increase, or he will remove them. This year, no staff training. If a staff is looking for, we have conference, you say you can go, we don't have anything for now. In fact, you know, they try to cut off those things. They have a target of meeting a particular profit that year. And you see, at the long run, some of those things, research and development, staff training, that they did not agree to do, may have effect at the long run. And from our notes, we see that directors know that their performance is usually judged on their short-term achievement. Shareholders' wealth, on the other hand, affected by long-term performance of the firm. You see that. So shareholders' wealth is always affected by long-term performance. Now, directors can frequently be observed to be taking a short-term view of the firm, which is in their own best interest, but not in that of the shareholders. So we move to the next one, risk aversion. So managers usually depend on the company for their salary, their career progression, and all of that. And this may make them to prefer low-risk projects, right? Now, if a company has two projects, project A will bring return of 10% and the risk is low, while project B will bring a return of 25% and the risk is high. The shareholder will prefer project B, while the manager will prefer project A. Why would the shareholder prefer project B? Because they want higher return. The shareholders are willing to take risk, right? Their appetite for risk is high compared to that of the directors, because they are after what is my take. So if we are to take risk of 10% and gain 10,000, is it not better we take that risk than we go and take risk of 20% and gain 60,000? They will now ask, what if we lose? You get that? So in situations like this, the shareholders prefer projects with higher returns, but the managers would prefer not, entering into such project, because they feel they will lose money. And if they lose money now, the shareholders will say, okay, you people invested in that project and we have lost. They feel their job is threatened. They feel that, they may not get what is due to them because of that. So managers may be risk averse, while shareholders may be willing to accept risk. So when we are talking about risk management, we'll look at all of those models for risk management. Okay, so let's proceed to earnings retention. Managers may prefer the company to retain more profits, because retained earnings can be used to expand the company. And this is what they'll present to shareholders. But inside them, they know that their remuneration, their status, and their influence will increase as the company, becomes larger, right? Meanwhile, shareholders will prefer higher dividend. Now, if let's say company A makes 1 billion naira profit, right? Now, the directors will say, let us retain 800 million and share only 200 million to the shareholders. And the shareholders will say, no, we want 700 million. Give us 700 million. You people should keep 300 million for the day-to-day running of activities. So you see that there is conflict here. There is conflict. Which one should we keep and which one should we share? And the managers are looking at their own benefit at the long run. Shareholders, they also want theirs. And the note here says, unfortunately, the remuneration of directors and senior managers is often related to the size of the company rather than its profit. So for this reason, executive management may favor a high retention policy, which implies growth in assets and size of the company. Like I said earlier, when their retained earnings is very high on their statement of financial position, you see that their net assets will be very, very high. It's going to imply a huge amount of growth. And on the other hand, the shareholders may favor a higher dividend payout, which implies more money for them to meet up with their needs. So this is also a conflict of interest between both parties. Then we have efforts level. Managers may not always put in the level of effort expected of them, especially when their remuneration is not linked to their performance, right? When their performance does not have anything attached to it, when there's nothing attached to their performance level, they may not really put up the work. They may see manager may not even come to work. Manager will be coming to work maybe 12:1, he doesn't really, there's no effort. He's not calling his subordinate. What have you done today? Have we done this? Why? Because there's nothing attached. There's no pay. There's no incentive attached to it. But once there's an incentive that you see everybody will be on. The manager will not sleep at night. He will just be thinking, calling friends. What do we do? You want to ask friends, and I do. He will be advertising the company. He will be the marketer. Why? Because of there's an incentive. So the effort level of the shareholders may be low, especially when there is nothing attached to that. Of course, you know that their salary is fixed. If you're going to pay me 100,000 naira at the end of the month, whether I sell or I do not sell. So what's the point of me wanting to sell? But if you now tell me that, okay, I'm going to pay 100,000 at the end of the month, and then if you sell up to so amount, I'm going to increase that 100,000 with additional 50,000. You see, I want to work more. I want to, I will go outside, stand in front, madam, come and buy. Why? Because of there's something attached to it. I will put more effort in that regards. Okay, so we move to agency costs. Agency costs are the costs and losses that the shareholders, that's the principal, incur due to the actions of their agents. These are costs attached to the use of directors running the affairs of the company for the shareholders. Now, talking about agency costs, we are talking about the costs that the shareholders incur as a result of the managers acting in their interest. There is a cost. They incur costs, and that's what we are looking at. The first one is the monitoring cost. Now, having the shareholder, the managers having, carrying out the day-to-day activities of the company, the shareholders, most of them, that's why we have opportunity for statutory audits where they get external auditors, right? And those external auditors are being paid, right? There's a cost. They are being paid to come and do what? To, assess the financial reports that have been submitted by the managers. They are being called to come and check them and give their opinion whether that a financial statement gives a true and fair view. Now, there's also internal audit in the organization. Now, normally internal audit is supposed to report to the audit committee, right? Now, the essence of internal audit is to do what? To monitor the activities of the managers. That is the essence, and there is a cost. When you have internal audit department in an organization, the staff there are being paid. So these are what? Monitoring costs. And this arises as a result of trying to ensure that management are acting in the best interest of shareholders. Now we move to bonding costs. Bonding costs are costs incurred to encourage managers to act in the interest of the shareholders, right? Now, the company can give managers incentive to align with their interests. They can tell them, okay, we are going to give you performance incentive. We are going to give you share option scheme, right? You can acquire, you can become a shareholder. So these are the things that organizations and shareholders put in place, to make the managers or the directors to act in their own interest. And those things are costs. They are costs to the shareholders. So bonding costs, bringing them to work in the interest of the shareholders. It could be through their performance bonuses, it could be share option scheme, it could be performance related, pay and all of that. So any cost that is attached to, bringing the interest of the shareholders with that of managers to be together is what we call bonding cost. Then we now have the residual loss. And this is a loss that remains because managers make decisions that are not in the best interest of the shareholders. These decisions are not in the best interest of the shareholders, but are in the interest of the managers themselves. Like example, we have a company's director decided to acquire a new subsidiary and pay more for the acquisition than it is worth. The managers would gain personally from the enhanced status of managing a larger group of companies and thereby resulting in loss in share price. So you see that any acquisition or any business transaction they tend to do, without considering the impact, their own is just, let's acquire them so that we'll have more worth on paper, so that our status will increase. I'm a manager of so group of companies. These kind of things at the long run, if it is a loss on share price of the shareholders, especially when due diligence was not carried out on that company that was acquired, and then you discover that the company was owing lots of money and you people have just inherited those losses, you see that there will be a loss in share price to the shareholders. Are we following? Thank you, Madam Chidima. Okay, so let's look at methods of reducing agency problems. Thank you, Madam Chikodi. Methods of reducing agency problems. Okay, the achievement of stakeholder objective by managers can be encouraged by managerial reward scheme, right? We are talking about how to reduce agency problems. What do shareholders do to reduce that problem, that conflict of interest? What do they do? And the first one talks about managerial reward scheme. So this is giving managers the reward that make them behave like shareholder. Making them feel among, making them feel that they belong. We are part of the organization, right? So that is one, and one of them is giving them a share option scheme. Imagine when a manager is given the right to buy a company share at a predetermined price, and that price is different from what outsiders are supposed to buy it. But because of his relationship in the organization, he's the manager, he's being asked, instead of 2 naira per share, he's been given 50 kobo per share. You see that? So this is a way of trying to reduce that agency problem, making them to know that, to have the interest of the organization, not to take some decisions that will tend to bring the company or reduce the wealth of the shareholders. So because they are now part of the shareholders, they will now, there are some decisions they will not just rashly take. They will scrutinize every decision before they carry it out, right? Okay, so from the note to say that managers can be encouraged to achieve stakeholder objectives by bringing their own objective more in line with the objective of stakeholders, such as shareholders. This increased goal congress can be achieved by turning the managers into shareholders. So when we talk about goal congress, we are talking about, the manager's objective being aligned with the shareholders' objective. That's what we mean by goal congress. Managers' objective being aligned with shareholders' objective. And this can be achieved through share option scheme, although the criteria by which shares are awarded need to be carefully considered. So the reward scheme could also be through remuneration of directors being tied to a level of profit. If we earn also amount of profit by the end of this year, every manager here, every line manager, every head of department, you have so amount of increase, or so percentage of the profits. Let's say the profit is 10,000. Every one of you have 2% of the profit, meaning that if there are 5 managers or if there are 4 managers there, the percentage, everybody take 2%, which is they are all taking 2,000. Then the 2,000 will now remain for the organization. So these are the things that help to reduce agency problem and help them to have the company at heart, the shareholders at heart. Their interests will be in line. Then we have performance-related pay. Now, part of managers' remuneration is linked to achieving specific targets. That's what this means. Is linked to achieving specific targets. It could be profit targets. It could be revenue growth. Maybe their basic salary may be 2 million, and then there is the additional bonus. If the company hits 10 million naira profits, we'll give you extra 5% or give extra 10% of your basic salary. So if your basic salary is 2 million, they are promising you 10 million, 2% of your basic salary. If the company has 10 million, you know what that addition will mean, especially during festive period that the person needs to, visit the family and all of that. So performance-related pay, part of the remuneration of managers can be made conditional upon achieving their specified performance targets, so that achieving this performance target assists in achieving stakeholders' objectives. So we move to the third one. Remember, we are talking about how to do what? Method of reducing agency problems. And the third one talks about corporate governance code of best practices. So these are rules and principles for ensuring that companies are properly managed and controlled. If we talk about corporate governance, there you have, the director's remuneration, risk management, internal control, audits, responsibilities of directors. So this is the principle that ensures that companies are properly managed and controlled. That is what Code of Corporate Governance is all about. Then we talk about stock exchange listing regulation. So listed companies have to comply with certain rules imposed by the relevant stock exchange or regulatory framework. So those rules encourage companies to disclose information. Now, if you look at this, this is certainly that information asymmetry, right? So those information that are hidden from shareholders, this particular regulation is instructing the management of organization on what to disclose, right? On information to disclose, so that they will not hold such information from those that are meant to know. So stock exchange listing regulation deals with what? Telling, giving out rules to encourage companies to disclose important information to investors, and this helps to reduce what? Information asymmetry. Right. Okay, then the last one we have monitoring. So shareholders can monitor management to ensure that they are acting properly. And that is why they audit financial statements. They also have some internal control checks, like their internal control. Some organizations have internal control department different from internal audit, while some organizations, the internal control and internal audit, they work together. So this internal audit or internal control department are there to do what? To check, to monitor the activities of the management. And that is why some organizations, some payments cannot be, not even some payments cannot be made without the audit, giving their signature, without the audit approving. Before the account will make that payment, the audit must have gone through and say, okay, pay, before account will make the payment. So these are processes of monitoring the activities of the shareholders, and it helps to reduce what? It helps to reduce those conflicts, agency problems. So one theoretical way of encouraging managers to achieve stakeholder objective is to reduce information asymmetry by monitoring the decisions and performance of managers. One form of monitoring is auditing the financial statements of a company to confirm the quality and the validity of the information provided to stakeholders. And that is why the auditor of the financial statement must be an independent auditor, right? Must not have relationship, must not have direct relationship, must not be a friend to someone in the organization, so that he can still maintain his independence and objectivity. Right. For those of us doing audits, we should be used to that. Okay, do we have questions before we move to the last part of this chapter? Do we have questions? Okay, I have a question for you. Now listen. A company's director decides to undertake a high-risk project. A company's director decides not to undertake a high-risk project with an expected return of 30% because they are concerned that failure could affect their employment. What type of agency conflict is this? Can someone tell us, please?
Risk aversion.
Thank you, ma. Risk aversion. That was a sharp one. Okay, I have another question. A managing director insists that the company retain most of its profits to finance expansion, while shareholders want a higher dividend. What type of agency conflict is this?
Retain in
Profit retention.
You people are ready for ICANO. That's a good one. Thank you very much. Okay, so we move to corporate social responsibility. This is the last part of this test. And we know that traditionally, the main objective of an organization is to maximize shareholders' wealth, right? But corporate social responsibility is challenging that. They challenge the idea that profit is the only responsibility of a company. They are saying that while a company should make profit for shareholders, it also has responsibility towards other stakeholders and the society. So when you're asked what is this corporate social responsibility, it means what? A company behaving like a responsible citizen. Just like parents can tell somebody to be responsible by considering the social, environmental, and economic effect of its activities beyond merely obeying the law. They are not just there to obey the law, but they should consider the environmental impact, the social impact, and the economic effects of their activities, of what they do on a day-to-day running of their business, right? So let's read the note and see. Corporate social responsibility has come to argue the fact that the major objective of a company is to maximize shareholders' wealth. Corporate social responsibility is a term to describe the view that a company should pursue objectives that are in the interest of stakeholders groups other than shareholders, such as employees and the society, that's the public. So the CSR is based on the concept that a company is a citizen of the society in which it exists and operates. Therefore, the company should improve social, environmental, and economic impacts beyond its legal obligation. And so there are two areas of responsibility. They have the general responsibility, and then they have the responsibilities that go beyond the general responsibilities. Now, the general responsibility, they see it as it is their normal duty. It is required by law, right? Meanwhile, this other one, it is what they feel they should do for the organization. It's not a legal requirement. It is what they feel they want to do for the society. Now, let's take, for instance, the law requires that they must pay tax. That is their general responsibility. That is a legal requirement. They require that they should comply with regulation. The law requires they prepare financial statements according to the relevant standard. Meanwhile, the BPA, the duties that are seen by some of them are like, they want to voluntarily build a school for the host community. They want to build their road. They discover the community does not have lights. They want to give them lights. So these are the two, key areas of responsibility. The general responsibility that are the key part of the board duties, which need to be completed in order to succeed in their industry, right? They are the regulatory and the legal requirements. And then the second one talks about their duties that are seen by some people feel what was this? Duties that are seen by some people feel. I need to check that. Okay, it goes beyond their general responsibility, right? Like I said earlier, activities that some people believe that the company should undertake, even though they may not be legally required. Yes, it's not a legal requirement, something they feel they just want to do for the organization, right? Okay, so let's proceed. So we have here that corporate social responsibility have 5 main aspects. For any company, some of these aspects might be more significant than the others. Now, corporate social responsibility have 5 main aspects. Now, it depends on the organization. Some may be more significant than the others. Now, the first one talks about that a company should operate in an ethical way and with integrity. Now, a company should, oh, wow. Give me a minute. Let me get my charger. Wow. I didn't even know I was not charging my laptop.
All right, thank you, ma'am. So as she's trying to get a charger, please, can you take down these notes where you can get questions on this topic? Yes. Please make sure you write it. I will expect you to answer these questions and forward to the group. I discover we are too cold, yes, on the group. So please, just a few minutes, ma. Can you just take these points down? November 2015, question 3. You see a question on stakeholder. November 2015, question 3. Write it with your hand. Yes. November 2015, question 3. May 2017, question 5. You see clear questions on all these. May 2017, question 5. November 2017, question 5. November 2017, question 6 again. Then we have May 2022, question 4. May 2022, question 4. Then November 2022 rather, question 7. November 2022, question 7. May 2023, question 5B. May 2023, question 5B. Then November 2018, question 7. Ma, are you set?
Yes, sir. I'm here.
All right.
Okay. Sorry about that. So we're talking about the corporate social responsibility, and we say there are 5 main aspects. The first one talks about a company should operate in an ethical way and win integrity, right? Now, a company should conduct its businesses honestly and fairly. They should not engage in fraud, corruption, false reporting, like, falsifying their financial statements in order to make it look good before the public. So imagine a company discovered that the accountants make an error that overstated their profits. Now, instead of the company to, make the correct adjustments on the financial statement, they will say, let us go ahead and show them. They will not see the error, and the error will not make the shareholders to be very happy, right? So the first one is saying that do the business the right way. That's what it's saying. Do your business the right way, not just the profitable way. A company should operate in an ethical way. Do your business the right way, not just the profitable way. Then the second one talks about a company should treat its employees fairly and with respect. Now, employees are very important stakeholders. In as much as some organizations tend to see the employees as not important, they are very important stakeholders. So a company should provide fair wages, safe work conditions, respectful treatment, reasonable working conditions, and opportunity for development. Now, for instance, a company should not, try to discriminate, and be saying that because you are a female, we'll pay you this amount. Because you are male, we'll pay you this amount. But they have the same qualification, the same experience, they are doing the same job. And then you're trying to do what? To discriminate in form of gender. That's gender discrimination. So even there's a law that states that even those that are, disabled should also be given opportunity to work. And that is why it's required that in the financial statement must show how many disabled persons, applied for job in your company, how many disabled persons did you employ. And most financial statements have been seen, they will say, no disabled person applied for a job during the year under review. No disabled person was employed. That is because it is one of the corporate social responsibility that a company should treat its employees fairly and with respect. Now, the next one says that a company should demonstrate respect for basic human rights. Companies should ensure that their activities do not violate people's fundamental rights, right? Now, a manufacturing company should not use forced labor or exploit workers. A company should also consider the human rights of people in communities where it operates. It should not, try to intimidate people because you are the company, you own the company, you feel that you can, always step on people's rights. You can always have your way, even in the host community where you're operating. You don't want to consider the welfare of the people. You don't want to consider their human rights. You just want to demonstrate that this company is your own. So corporate social responsibility is saying that a company should do what? Demonstrate respect for basic human rights. Then a company should also do what it can to sustain the environment for future generations. Now, a company should consider the effect of its activities on the environment and future generation. Now, imagine a manufacturing company. They should be able to control the pollution coming out from their company. They should properly dispose their waste. They should reduce environmental damage. They should also use resources responsibly. Now, if these things are not put in place, if they are not checked, like let's still take, for instance, the oil spillage. If they are not being handled, if they are not put in, if they are not regulated to reduce such damage or to clean up the spillage, you see that the future generation will suffer it. Because imagine when a child is growing and there's no good water in the area, they don't have, the whole place is messed up, their farms are messed up with spillage and all of that. So it's going to, it will affect future generations. So a company should do whatever it can to sustain the environment for the future. So they should not just satisfy today's needs by destroying the ability of future generations to meet their own needs. They should put it into consideration to sustain the environment for future generation. So we have here ethical issues in financial management. So now we have moved from CSR generally to ethics in financial management. Now, in pursuing profit and shareholder wealth maximization, companies should act ethically. And in giving advice, financial managers should be conscious of any ethical issues that might be involved in the matter. Business ethics covers aspects of business behavior. Now, under ethical issues in financial management, right now we are looking at the business ethics. Remember that financial managers make decisions involving investments, financing, dividends, risk management, and the likes, right? So because these decisions affect many people, financial managers must consider whether their actions are ethical, not merely whether they are profitable. Right. Now, suppose a financial manager knows that a company's financial position is actually poor, but they deliberately hide important information from investors. This action might temporarily protect the company's share price, but it is unethical. So financial managers should pursue shareholders' wealth while remaining honest, fair, and responsible. So the business ethics refers to those moral principles and standards that guide how a business should operate, how a business should behave. And one of it is what? Honesty and integrity in business dealings with others. So a company should be truthful in its dealing. Don't falsify financial statements to obtain bank loan. All your activities should be with what? Integrity. The second one talks about concern for other stakeholders, such as employees, suppliers, and customers. The company should consider the interests of these persons, these other stakeholders, right? Don't deliberately sell defective products because the customer may not know. You feel the customer may not know. You just want to sell, right? So they must have concern for other stakeholders. Now, they also have respect for human rights. The company should not exploit or abuse workers or other people, right, affected by the operations. They should not abuse their workers. They should not exploit them. You say you work 8 to 5, and then the staff is going by 5:30. You're offended. You say no. You work 6. You work 7. Every day you want to bring out laws. You want to bring out rules that make the staff to feel choked, to feel exploited. It said respect for human rights. That's what that place talks about. Then concern for the community. Concern for the community or for the environment. Businesses should minimize harmful environmental effects. Those pollutions, those things, what kind of business do you do? How does it affect the environment? These are things they put in place when they are citing their business, and as the business progresses, they tend to check what have been done so far. Is the community happy? And what's our impact on the environment? So these are the things they should look at for when it comes to business ethics. Then they have recognition by large companies of the social responsibility to the communities in which they exist and operate. So large companies, especially those operating in communities, should recognize their impacts. Like we have some mining companies that may try to, support some community development, some oil and gas, they want to support education and the healthcare sector. So these are the business ethics. Then we now have corporate code of ethics. A corporate code of ethics is a formal set of ethical principles and expected behaviors issued by the company's board of directors to guide the decisions and actions of employees, right? So in simple terms, it's just like a company's rule book, right? Company's rule book. Some organizations, once they get a new staff, in the process of onboarding, these are part of the things they hand over to the staff. One of it is their rule book. So it talks about their ethical behavior, right? It tells this is how we expect you to behave. The company's code of ethics will be stated there for the employee to see. And the note says, a corporate code of ethics is a code of ethical behavior issued by the board of directors of the company. The decisions and actions of all employees in the company must be guided by the code. The effectiveness of a code of ethics depends on the leadership of the company. So here is also talking about, when that code of ethics have been issued by the board of directors, for everyone in the company to know, the directors, the employees, everyone, both senior and junior staff should know. Now, for that code of ethics to be effective, it depends heavily on the leadership of the organization. That's the senior managers and the directors, because they must personally comply with the code. Why? Because the staff, the employees, they are watching what the managers are doing. Now, the effectiveness of this code of ethics depends on the leadership of the company. It is directors and senior managers. These individuals must be seen to comply with the ethical code, or other employees will see no purpose in complying with the code themselves. That's the way it works. We like to follow what our leaders are doing, right? So if the company says that let's say falsification, fraud, and all of those things are not are prohibited in the organization, and then the managing director is secretly trying to falsify, telling the accountants, let's do it like this, trying to, make them falsify accounts or make them do what is prohibited by their code of ethics, then those that are under them will like, but it's not what the code says, right? So for this to be effective, the leadership must lead by examples. And lastly, we are looking at 3 reasons why companies might develop a code of ethics. Reason number one is managing for compliance. So the company may want employees to understand and comply with what? Their laws, their regulations, their company policies, their ethical standards, right? This is one of the reasons why companies develop a code of ethics. Let everybody know what we want. Let everybody know our rules and regulations, so that what they will comply. You cannot comply with something you don't know about, right? So they manage. One is managing for compliance. That is wanting employees to understand and comply with. That is doing what is required of them. Now, the second one is managing stakeholder relations. The company uses the code to promote good relationship with stakeholders. Remember, when we talk about stakeholders, we're talking about customers, employers, government. So it is at this point now they are trying to manage relationship because their code of ethics talks about customer relations, ethical behavior, how do we, relate with customer, timely delivery and all of that, how we pay our debts, payments or to lenders and all of that. So it helps them in managing stakeholder relations. And then the last one talks about creating a value based organization. Now, this one goes beyond obeying rules. The first one, managing for compliance, talks about obeying rules, talks about, complying with what the code says, right? Now, compliance, you just do it because the rule prohibits it. But when you're talking about value-based, creating value-based, we don't do it because it is against our value. It's not our value, right? So the company wants the ethical behavior to become part of it. This is talking about the culture now. We're talking about the culture. Every organization have their culture and their values. So this one now, this creating a value-based organization is like imbibing inculcating the value in the people. We don't do this thing because it is against our value. While the first one talks about, we don't do it because of what? Our rule, our regulation prohibits it. While this one talks about was our value. So the creating a value-based organization goes beyond just obeying rules. It talks about a company wanting ethical behavior to be part of its culture and values. Right, so we have come to the end of introduction to strategic financial management. Do we have any question? So have we looked at the questions in the material? Have we looked at it? I mean, somebody have not even looked at, I've not even seen that there's a material in the group. Is it possible? Okay, so last time we talked about the question number 1. Yeah, we are asked to define and explain the common elements contained in the definition of strategy by Chandler, Drucker, and Johnson, Scholes, and Whittington. We looked at that the last time. I think I'll have to get solutions to all of this for our private study. So let's look at question number 2. Explain the meaning of strategic financial management and distinguish it from conventional financial management. Who wants to try? Explain the meaning of strategic financial management and distinguish it from conventional financial management. Who wants to try, please? Who is talking to us? The difference, looking at SFM, that's strategic financial management, and normal conventional financial management we used to know. We should not forget that strategic financial management focuses on a long term. If you're making your decisions, right? Now, strategic financial management has to do with formulating and implementing financial strategies, right, that supports long-term objectives. You get. Now, when you're talking about strategic financial management, you're talking about focusing on long-term. While the normal conventional financial management we know talks about short-term financial issues, we concentrate more on short-term financial issues. Strategic financial management, tends to link financial decisions to the corporate strategy. That's the key word. Linking financial decisions to corporate strategy. While the conventional financial management concentrates mainly on financial techniques and decisions, right? Now, also, this strategic financial management considers the external environment also, right? They consider the external environment before they make their decisions. They try to look at, their environment around them, the threats and all of that. Meanwhile, the conventional financial management focuses mainly on their internal financial matters, right? So these are some of the things. Also, strategic financial management looks at risk and uncertainty in their strategic decisions, while conventional financial management deals with their existing financial problems. So some of these things are something you think about in what is happening around you, right? And you'll be able to know what to write on them. I don't know if I'm communicating. Please, let's respond. Okay, so do we have anything to say on question number 2? Does anybody have anything to say? Okay, so let's just look at this question 3. Explain the relationship between financial strategy and corporate strategy. Who can help us? Financial strategy and corporate strategy. Is someone there? Explain the relationship between financial strategy and corporate strategy. So the corporate strategy is the overall strategy of the organization, right? Is the overall strategy of the organization. It determines the organization's long-term direction, their objective, their scope, their goals. So it covers the overall strategy of the organization. While financial strategy is a component of the corporate strategy, right? But this one now, it is concerned with obtaining, allocating, and managing financial resources. Corporate strategy talks about the overall strategy of the organization, while financial strategy is a component of the corporate strategy that deals with obtaining, allocating, and managing financial resources to support the achievement of that corporate objectives. I hope we are following.